The IRS forces you to withdraw money from your retirement accounts whether you need it or not. But smart retirees use these 3 strategies to minimize the damage and save thousands on their tax bill. I'm Josh, a CFP and partner at an award-winning retirement firm. I've helped over 500 clients navigate required minimum distributions, and today I'll show you exactly how to handle yours tax efficiently. We'll start with the reality most people just don't want to face. Once you hit your RMD age, which is either 73 or 75 for most people, the IRS stops being your friend, if they were ever your friend to begin with. They're done letting you defer taxes on that traditional IRA or 401k. They want their money, and if you don't give it to them by December 31st each year, they'll hit you with a 25% penalty. That's not a typo. Miss your RMD and you could lose a quarter of what you were supposed to withdraw. But here's what nobody tells you. Once RMDs start, your tax planning options shrink dramatically. The flexibility you had in your 60s, that's gone. The ability to control your tax bracket, much harder. This is exactly why smart retirees plan ahead. You can probably pick up by now that planning ahead is going to be a common theme on this channel. Let me tell you a quick story. My fiance and I want a long engagement, about 1.5 years. But even though we have all that time, I started wedding planning early. Why? Because starting early gives me better control over every single detail. The venue, the location, the vendors. If I waited until wedding day, I'd be stuck with whatever scraps were left. RMDs, they work the same way. Plan ahead and you have options. Wait until you're forced to take them and you're stuck with whatever the IRS dictates. Let's start with the basics because getting this wrong is expensive. Your RMD age depends on when you were born. If you were born in 1951 through 1959, your RMDs start at age 73. Born in 1960 or later, age 75. The IRS calculates your RMD using your account balance from December 31st of the previous year. They divide that by a life expectancy factor from their IRS tables. The result, as you guessed it, is your required minimum distribution. And here's the key word, minimum. You can always take more, but you cannot take less. Now, here's something most people miss. You don't have to take your RMD from every account separately. If you have multiple traditional IRAs, you can calculate the total RMD for all of them, then withdraw that amount from just one account. This gives you flexibility in which investments you sell and when. Strategy 1 here is to take monthly distributions throughout the year. One of the biggest mistakes I see retirees make is taking their entire RMD in December. If you don't plan ahead for this, you can be adding a massive income spike for the year. Instead, set up monthly distributions throughout the year. Here's why this works. First, it spreads your tax burden evenly across 12 months, instead of creating that one lump sum event. Second, it helps with cash flow planning. You know exactly how much income you'll receive each month. The key here is automation. Set up systematic withdrawals from your IRA to your checking account. Most custodians will make this really simple. You specify the amount and frequency and just let them handle the rest. No more scrambling at year end and no more accidentally missing that deadline. Strategy 2 is to look at qualified charitable distributions. This is where the magic happens for charitable-minded retirees. A qualified charitable distribution, or QCD, lets you send money directly from your traditional IRA to a qualified charity. The distribution counts towards your RMD, but it never appears as income on your tax return. Let me repeat that. The money satisfies your RMD requirement, but you pay 0 income tax on it. For 2025, you can do up to $108,000 in QCDs per year if you're age 70 and a half or older, and that's per person. And here's the best part, it also helps you avoid IRMA costs on Medicare. IRMA, which we mentioned before on this channel, is the income-related monthly adjustment amount. Basically, if your income is too high, Medicare Part B and D premiums can skyrocket. We're talking an extra $4,000 to $5,000 per year in Medicare costs for higher income retirees. But QCDs, they don't count as income, so they don't trigger IRMA. You satisfy your RMD, help your favorite charity, avoid income taxes, and keep your Medicare premiums low. That's a quadruple win, which is rare in tax planning. The process is straightforward, but the details do matter. You must be 70 and a half or older. The distribution must go directly from your IRA custodian to the charity. You cannot take the distribution yourself and then write a check to charity. That defeats the purpose here. And the charity must be a qualified 501c3 organization. Your custodian or advisor will usually handle the paperwork here, but you do need to request it specifically. Strategy 3 is delaying your first RMD. Here's a strategy most people don't know exists. You can delay your very first RMD until April 1st of the year after you turn your RMD age. But there's a catch. If you delay your first RMD, you'll have to take 2 RMDs in that second year. The delayed first one plus your second year's regular RMD. Why would anyone want this double hit? Let me tell you about my client, Adriana. Adriana retired the year she turned 73, which was also her first RMD year, but she had employment income of $500,000 that year. That's more than double what her RMD would have been. Taking her RMD on top of her big salary would have pushed her into the highest tax brackets and triggered massive IRMA costs. So we delayed her RMD until the following year. In her first retirement year, with no employment income, she could handle both RMDs at a much lower tax rate. This strategy saved her thousands in taxes and kept her Medicare premiums much more reasonable. But this only works if you have a good reason for the delay. So if your income is going to be similar in both years, taking that double RMD probably is not going to help you. You need to look at your specific situation. High income in your first RMD year? Consider that delay. Similar income in both years, just go ahead and take your RMD on schedule. Let's go ahead and put this all together. The key to RMD success is, as you probably guessed, planning ahead. Don't wait until December to figure this out. Start planning now. Calculate your expected RMD for the year. Decide if monthly distributions make sense. Evaluate whether QCDs fit your charitable goals. And if it's your first RMD year, run the numbers on whether delaying makes sense. Remember that once RMDs start, your tax planning flexibility decreases significantly. But with the right strategy, you can still minimize the tax impact and maintain some control. The worst approach, ignoring RMDs until the last minute. That leaves you scrambling, limits your options, and often results in paying more tax than necessary. Smart retirees treat RMDs like any other part of their financial plan, something to be managed proactively, not reactively. Your future self will thank you for starting this planning now, rather than waiting until you're forced to take action. Proactive tax planning doesn't just stop here. You need to watch this next video so you can continue to take action on reducing your retirement tax bill. Thanks for watching, and we'll see you soon.